Certified MSc. All right. There you go. Perfect. Interesting. Hey, what's up with y'all, man? Oh, y'all were coming in early. Well, I was getting things set up. I just want to say, and I don't know why that I am like this, but I am really excited to talk about taxes today. And that just means that I might be a little weird, but I think it's really cool the way that you can strategize to keep that cash. So what's up with you guys, man? I appreciate y'all coming in right on time. Waves. Hope everyone is getting ready for a wonderful Christmas or holiday season for those who celebrate different ones. We're just waiting on Erica to join, and then once she's here, we will get this thing roll up. There she is. I see her there. I see her. All right. You are. Bingo. This is the easiest one yet. Shoot. How y'all feeling today, man? Just let me know. Hey, Erica, because we know a bunch of people that I will be clowning Malcolm because of how easy it was for you to do this. So I'm happy to have you.
To be surprised, this is actually the very first time that I've ever gone live on IG. So I'm glad it worked out.
It's a good thing. It's a good thing, and I am happy to have you. So let's just dive right on in. For those who don't know, my name is Calvin Williams, the founder of Freeman Capital. I need to get a haircut, so I'm rocking the hat today, and that's just what we're doing today. And today we have a very special guest with our Ask Us Anything, a tax expert. We have Miss Erica. Erica, please give them your bio. Tell them about just a little bit about how qualified you are to speak on this topic, and then we'll go right into what we have today.
Okay, yeah, thank you. And I want to make sure everyone can hear me. I might need to put my headphones on. You're good?
Crystal clear. You sound great.
Okay.
You sound great.
All right, perfect. So, yeah, my name is Erica James. I am a CPA. I am a candidate for the CFP, which basically means I passed the exam and I'm in the experience getting process of it all. So any day now, I should be able to put those three letters behind my name. I have about 10 years in the accounting space. So I started out in audit and did a little bit of tax and not-for-profit, and then really just realized that, my passion is helping people build wealth. And so that led me to pursue the financial planning track. So I've been doing it for about 2 years now, 2.5 years with an organization, SBSB Financial Advisors, and just really excited to be in the space and learn more and share with our community.
Exactly, and that is why I'm happy that you are here. Philly, I saw you in the building. Please feel free to shout out where you guys are from as well. And if you have tax questions, go on and drop them. Now, for those who this may be your first time, know that those who are already a member of Freeman Capital, they're already either on our email list or they are a customer. They got first chance to get their questions in, and we have a lot of questions. I hope that we can get through all of the questions in just our 30 minutes because there is a lot. But so let's just take a big step back, Erica, and then let's dive in. Why is tax planning and tax management so important for folks to think about? A lot of folks think about getting money, but where does tax planning and tax management really fall into in terms of level of importance of building and sustaining wealth?
Yeah, I love that question. I think we all are familiar with the idea that, there's two things we can't avoid, and it's death and taxes, right? So if you can't avoid the taxes, how can you mitigate the taxes or reduce the amount of taxes that you pay? And we all know the stat that, our current president paid $700 in taxes, and you're wondering how does that happen? And so tax planning is important because there's the tax code is 7,000 pages long, and there's just no way to know it all. But there's a lot of things in there that if you understand it or you work with someone who understands it, then it can help to minimize the amount of taxes that you pay. There's credit, there's deductions that a lot of times we miss out on because we say, oh, I want to save $100 and do my taxes myself. Whereas, you might pay a professional and they can really open the world to you and say, hey, because you did this type of transaction, there's this tax consequence. And that's really what it's all about, right? Like when you're talking about making money, the United States is one of the only countries that taxes you regardless of where you live. So being a US citizen, you will get taxed. And so you really want to know and plan around what that looks like so that you can minimize your taxes.
No, that's a wonderful overview, and maybe that's why I'm so passionate about taxes, because I love having my meetings with my tax planner and figuring out how are we going to make sure that I am paying the right amount, but not too much. All right, so we're going to dive into some of these questions. The first one is from Elena White. Oops, I shouldn't say her full name, but sorry. Elena, too late. I'm feeling good. It's like the holidays are coming. You caught me in like a really cool vibe. All right, but so I'm a generalizer, right? So in these times of COVID, we got folks who are not working where they used to. Like they might have been living in one place and now they're moving to another. Like how does that impact with their taxes? Because they used to be in one place and now they're reloading to either for family or for cost of living. How can they deal with all of that in terms of taxes?
Yeah, so that's a good question. And 2020 has really brought that to light. And it gets into the very, the technicalities of taxes and the code and really the two things that you have to think about are domicile and state of residence. And they sound like they might be the same thing, but they're actually not. So domicile is really your permanent residence. Where do you have your car registered? Where do you have a driver's license? Where's your principal residence, your home, even if you're not there for a period of time? That's considered your domicile. Whereas your residence can vary depending on where you physically are, right? So some people picked up and said, hey, I'm going to Florida, right, for this pandemic because it's warmer. Why not, right? Let's go live on a beach for a couple months because we can. And so being in Florida is one of those states that does not impose taxes on their residents. And each state has the ability to say what makes you a resident, and it's typically it can be if you're there for more than 6 months, or if there for X number of days. And so you kind of do, if you've been away from your domicile, like where your house is, your car is, your bank accounts, for a period of time, you probably want to talk to a professional tax advisor to understand, like, hey, do I need to file in this other state? Florida doesn't have a tax return. They don't have tax filing requirements, so you wouldn't need to file in Florida. But say you picked up and you went to California, like now you're really talking, because California and New York have some of the highest state tax rates. So there's the ability to get a credit, right? Like New York might give you a credit if you end up having to pay taxes in California. But New York, because New York is your domicile, or wherever you live, I'm in Virginia. Virginia is your domicile. You still need to file a tax return in that state.
Yeah, that to me is like why building wealth is so personalized, right? Because there are so many nuances that can go into your specific situation. And without that understanding, and as we know, like when you talk about the wealth gap, a major problem that is like access, like getting this type of expertise so that you can move like how you want to move, but not get dinged on the back end when it's time to pay taxes. So that's really kind of key to break down. And of course, if you do have questions, that you can join over at Freeman Capital. You can get on the email list and you can be first in to drop in these questions. So the next one that we got is also around, of course, taxes. But all right, so we have Rachel, who is gearing up for their first home purchase, which is a major move. Rachel, shout out to you. You're doing big things. Are there anything that she needs to prepare or think about when it comes time to minimizing the tax impacts when they're buying their first home?
Yeah, so I think a lot of people think that, okay, I'm about to buy a home. There's going to be all these taxes that I really need to worry about. Like, what should I do? What can I do? First of all, good for you, Rachel, I think it was, for even thinking about this. But really, the taxes are imposed when there's income. So purchasing a home is not a taxable event, right? Having a home, being a homeowner does allow you certain taxable deductions. So after you purchase that home, you have a mortgage on that, you may be able to deduct the interest that you pay on the mortgage.
Yep.
You may be able to deduct the property taxes, and I say may because again, it depends on the situation, right? And I should have started with this, but all of this information is generalized. Please don't take anything I'm saying and go, make a tax move or whatever that looks like, because you really have to look at the individual situation. But when it comes to purchasing a home, it's not a taxable event. It's when you sell that home. So that's when you really want to do some planning before you just up and sell your home, because you might be looking at a $50,000, $100,000 capital gain that you didn't plan for, right? And you can manage anything that you plan for. It's when you don't plan for it that it becomes a problem.
Yeah, so you're selling that house, feeling excellent because you're looking like, oh, I got 50K in equity. I'm feeling good. But then you don't realize that you're going to have to pay, if you don't plan for it right. The tax man wants his share of that income of that capital gains that you have. That's a really
he
good
wants
point.
it and he will get it. So
So actually, there's another real estate question. So Jordan said, now we might have to break down a couple of these terms to make sure that we're all on the same page. It's really important for us at Freeman Capital that we don't just provide just education, but we empower. So how to structure real estate acquisitions to maximize accelerated depreciation. So Jordan knows some things that the regular person doesn't. So let's just break down a couple of terms. So like in terms of, sorry, I just lost it. So in terms of what is first, let's at a very high point from a tax perspective, depreciation, and then the acceleration part, and then what are ways to think about it at a high level. And yes, this is all general information. If you want one-on-one, you got to come to Freeman Capital, and then we'll take care of you. But Erica, please, begin to frame up this question for us.
Yeah. So depreciation again is very much, you hear about it when you talk about purchasing a car, right? Like you buy a car, you drive it off the lot, it begins to depreciate. In the tax world, people tend to think about expenses. So you go out and you buy something for your business, or you buy this building, you can write that off. Well, depreciation is essentially saying, okay, you can't write off 100% of whatever asset you just purchased this year. And the reason that they do that is because they know, you go out and you buy $100,000, like you're going to write that off. They're not going to make any money. So they've spread that out over, depends on the asset, it could be 3 years, it could be 39 years, right? Depending on what the asset is. And so accelerated depreciation is something that's been written into the tax code where you can write off more of it up front. So you don't have to wait 3 years. You don't have to wait 39 years to be able to take that deduction against your income. And that's really powerful because reducing your taxes now gives you more money to make investments. And that's really where those provisions came from, right? Like they want people to have cash in their pocket so that they can go out and stimulate the economy. So go ahead.
Let me just jump in for a second to make sure that, we can frame it well. So when you're talking about this depreciation, the accelerated depreciation is you're looking at your projection tax bill and you're like, you know what? I want to pay less in taxes, maybe even get a refund back.
Yeah.
And so what this person is saying, Jordan, is like they want to figure out how to work with someone to help bring all that depreciation that's supposed to happen over many years and slam it into 1 year and then drop down their whole tax bill. Is that like not the gains, but like the strategies that folks can do when they're working with a professional, right?
Absolutely. And that's the thing. Yep, working with a professional, it's strategizing, right? So I think in our community we tend to confuse the concept of a tax preparer with a tax planner, right? So when you're talking about, this person's a CPA or this person just does my taxes, there's a difference. It's entering the numbers in a tax return. There's software that can do that, and can probably do it yourself. And there are definitely situations when it makes sense for you to do it yourself. And then there are other times when you really do need to work with somebody. So having a preparer means they are putting the forms together, they're getting the numbers in, you're signing off and sending it in. A planner will help you decide and determine, okay, how much of this depreciation can I move to this year? What expenses should I incur this year, or wait to recognize certain income in this year versus next year? And that's really how you start to manage your taxes and build wealth.
That is key. So let me ask another question on that kind of same point. So in terms of, you know what, I just forgot. My question just left me. And it will be a good one too, but it will come back to me though. So, you know, at this time of the year, people are setting up their accounts for next year. Yeah. And one thing that they have to set up is a flexible savings account. So, you know, most or a lot of jobs come with those. If you can kind of tee up like what's the difference between a flexible and a health savings, and then really like what do you think is the value in a flexible savings account from your job?
Yeah, so just, you know, high level really quickly, a health savings account, HSA, is very similar to a flexible savings account in that you're setting aside pre-tax dollars to pay qualified medical expenses, right? And I say qualified because the tax code specifies what you can apply those dollars to. But the key with the HSA is that you have to have a high deductible plan. And most employers offer that as an option. Whereas an FSA is what I think most people tend to gravitate towards, just because, you know, maybe we're young, we're healthy, we don't really need a high deductible plan, or whatever that looks like. Or you have a family and you want to pay a little bit less in your upfront costs, and so you have maybe like a PPO or an HMO, and that's when you might have the option to have that flexible spending account. And so, you know, the things I think at year end to be mindful of with having a flexible spending account is that, you know, that money is use it or lose it. So when you signed up, right? And
I have lost before. I picked the wrong choice, thinking I was good, and lost like $700 in 1 year, and I was pretty salty.
And it hurts, right? Like the last thing that we want to do is lose money when it's like I want all mine. And so the flexible spending is one that you put it into this account, and you kind of have to think ahead. What am I doing this year, right? Like you can't predict health. Like as 2020 has shown us, you can't predict health. You have no idea what's coming. But maybe you can look at last year and kind of gauge, okay, I need to do these doctor's appointments. I got to get these dentist appointments. Anyway, what you want to do at the end of the year, you really want to understand what your plan rules are. So you need to talk to your employer, whether that's HR, payroll, whoever manages that. But you want to understand what is the year for the plan. So for my job, for example, we're actually April through March. And so I have, I don't know why, but April through March. And so I have until March of next year to use up the dollars that I've been putting into my FSA. Whereas if somebody has a calendar year, they've got, 14 days to spend that money. So you really want to understand what's in there, how much do I have left, and your plan may offer the ability to carry over some money. So the tax code has it built in that you can carry over up to $500. Again, your company has to build this into their plan, so you want to understand how yours is set up. Or you might have a grace period. So you might have an extra 2.5 months. So that'll put you March 15th to use that money. And for the ladies out there, one of my friends just informed me that she didn't know this. Recently, they have revised the qualified medical expenses to include feminine hygiene products. And so, you know, if you get to the end of the year and you've got $100 left,
stock it up.
Go stock it up. You know, back it under the bed, do whatever you need to do, and then also over-the-counter prescription medication, because that was not previously available.
And so I just said I love so this all comes from like tax planning, right? Because the money that goes into these accounts goes in pre-tax, so then it lowers
Yes.
your adjustable gross income. That's income that you are taxed on. And then for me, because I'm gonna be honest, a brother needs a massage, right? So I went and saw my doctor. Was like, man, I got some muscle cramps, so I need you to write me a prescription to get a massage.
Yeah.
You know, so then I took that to my a massage place that took
Yeah.
HSA. Now my massages are being paid for with pre-tax dollars, and I'm feeling good too. And then like for me too, like I love these accounts because it really enables you to like strategize. And we just talked about, I want to get my smile right, so I went and got that a good Invisalign. Pre-tax dollars with my health savings account. So there are a number of ways to like think about what do you want to do, and then figure out what is the best ways to pay for those things. And I remember what my question was. I know this was the previous rule in 2019, but I don't know if Trump changed it with his tax laws. But I thought that you could deduct the cost of a tax preparer from your taxes. Is that still true?
That is no,
I know it's like flat right. It's off. We were prepped for that, but I'm just wondering.
no, that's
Did they
fine.
change that?
That's fine. So yes, before the Tax Cuts and Jobs Act, you could deduct the cost of your tax preparation as well
Yep.
as your investment advisor fee. So if you have a financial planner, those were deductible.
Yep. Yeah.
Unfortunately, those are no longer deductible. They were
Both of them. Us, and you.
both of them. Yeah. And so one of the things that is with the tax repair, I will say, if
Yeah.
you are a business owner, you can still deduct a portion of it, right? Because
Oh yeah.
your tax preparer is doing a portion for personal and a portion for business. So you
Yeah.
have to split it up accordingly, but you can still kind of get in a little bit of deduction there on the business side. But for personal, yeah, that's gone away, unfortunately.
Okay. Okay, well, never mind that. All right, so we got a little bit more time. We still got a lot more questions. This has been a great convo. Let's kind of stay on the business tip here because we got some more questions about
Yeah.
write-offs. So if someone has a small consulting business, they're asking, can they really write off cars, dinners, and is there a minimum number of income or revenue that you need before writing off? Like this is a big deal because everyone talks about, oh, just write it off. Like you can, but you can't. You got to do it right. So just go on and teach the people.
Yes. So good question. The first thing you ask is, can you really write off your car and your meals? And the answer is yes and no, right? So
Yep.
you can write off the business portion of your car. You can write off the business-related meals up to 50%. So meals are specifically limited to 50%. So, don't go ball out and say, oh, we're going to go have this $200 business dinner and expect, right?
Yeah.
You only can deduct $100 of that, for example.
Yeah.
As far as the car, there's an expectation that if you only have one car, you're using that for personal reasons as well. So you have to be realistic about, what is the personal use versus the business use, and that's the portion that you can write off. And there's two different methods when it comes to calculating vehicle expenses, and this is where a tax professional can help you, but you can write off the miles, or you can write off like your actual oil and gas and all the maintenance and that sort of thing. So
Can I just jump in for just one quick second?
Yeah.
So because I really started to write off my miles like 2-3 years back, and now we aren't driving, so it doesn't matter. But there's a really cool app called Mile IQ, and what it does is, I mean, just like Google Maps, it tracks when you, like for me, when I turn on my GPS, the app turns on and then tracks where I drive.
Okay.
And then at the end of the day or drive, it just tells me like what was a business trip, what was a personal trip, and it just lets me have like a quick export that I can click, send that right to my tax preparer, and like my wife and I probably wrote off like 16,000 miles just last year alone. So like And again, it's all about tax prep, tax planning, getting with someone that can work with you one-on-one. But I'm sorry, Erica, but you brought up the mileage part, and I told you I love this freaking tax law. I should be a CPA because I'm not excited about it, but I didn't want to sit no
we
test.
need more, but we love what you're doing as well. We need what you're doing. So I want to address what you just said, because that is so clutch, right? Like, technology has made it such that it's easier for us to track all of these things real time. And I think what I've seen and what I know is that the hardest part of taxes and tax planning is having the information. So if you do yourself a favor, do your tax planner a favor, and just track things simultaneously, it will make life so much easier. And then another thing with the miles because you reminded me, is that a lot of people may or may not know that as a landlord, so you own a property and you're running back and forth and checking on the house, you can deduct the miles that you incur when you're working on your property. So just a little.
Or health. When you're going to the doctor, you can write off those miles too.
Exactly. Medical miles, charitable miles, those are the other. So they're at different rates, so you want to know what those rates are. But if you're driving around and you're doing Meals on Wheels or that type of thing, like, you can deduct miles for that. So
yeah, man, miles on miles.
Miles on miles. But I did want to address the other question in your last question about the minimum level of revenue, right? Because I think
Great point.
Really important just to highlight is that when you're starting out a business, it's to be expected that those first couple of years might be net negative, right? Like, you're going to have a loss. And so a lot of people tend to think, well, I don't want to take these deductions or these expenses because then it's going to look like, I don't have a business. In the first couple of years, that's expected. The actual rule is that the IRS is going to look to the 5 years that you've been in business and say, hey, has this person shown a profit in 3 out of the 5 years? And if not, then they might look and say, okay, if this is continuing and this person just has a business and they keep writing it off, they're going to call it a hobby. And so that raises the flag. And hobby income and hobby expenses are treated differently than business income and business expenses. So there is no minimum revenue that you have to have, especially starting out. But if it's a trend, then they're going to say, you're not serious. This is not a business. This is not something you're trying to make money on. You're just trying to get these losses.
So, Erica, I have loved this because, I love taxes. And that's probably not a statement that's made very often. But I really I am generally I really enjoy tax law, just finding out ways. Because, I think that in a very fair way that, you can really, secure your wealth by planning for this as best as possible. So we're coming to the tail end. We got to a bunch of these questions. The folks who we didn't get to, we'll follow up with you all one-on-one. For folks who have questions and you haven't gotten them answered yet, feel free to come to freemancapital.co. You can chat with a team member there. We'll try and help you out. Erica, please, thank you so much. Tell folk how they can find you and kind of anything else that you want to say before we wrap up today.
Yeah, thank you so much. I'm so happy to be here again. And, I am on LinkedIn. You can find me on LinkedIn. And I work at SBSB Financial Advisor. So the website is sbsbllc.com. You can connect with me there. But yeah, Freeman Capital is doing it, and I really appreciate what you're doing in the community and the space, because we need this information, right? Like, we need the information from people that are doing it and the trusted information, right?
Exactly. Yeah. And so I won't say it any better than that. Like, if you have one-on-one questions, it is always great to get general information, but it's not good to have general information and then apply that to your specific situation.
Yes.
Your situation is unique. Your wealth building goals are special. You matter. And so that's why we built this, so that you can get started and work with folks like Erica, like the rest of our planners, who can put you in a position to succeed. So thank you all so much for checking in. I hope you all have an amazing holiday season. We will do this again in January. I think it's going to be the third Wednesday or Thursday in January. Sign up and you'll get the email. But have a great day all. And Erica, thank you so much. You made this one great, man. So
Thank you, Calvin. This was awesome. My first IG Live, I think it was a success.
Yes, it was. Yes, it was. All right, then. Take it easy.
Bye.
Bye-bye.